Germany's VC market after the correction stable is not strong. Hello and welcome everybody. This is Joe from Startuprad.io, recording from Frankfurt am Main, and today I want to talk about something that is going to sound at first like good news, because the headlines, when you read the latest KfW venture capital dashboard for the first quarter of 2026, and when you read the EY startup barometer from January 2026, look almost reassuring. The German venture capital market has stabilized. Roughly 7.2 billion, yes, would be euros invested in 2025 according to KfW. Almost 8.4 billion according to EY. About 1.7 billion euros raised by German startups in the first quarter of 2026, which is essentially flat compared to the first quarter of the 3 years before. That sounds calm. That sounds, finally, after the boom and bust of 2021 and 2022, like a market that has caught its breath. But here's the catch. Stabilization is good news only if the world around you is stable. And the world around the German venture capital market in 2026 is anything but stable. Artificial intelligence, defense, energy, climate infrastructure, biotech, robotics, hardware, these sectors have made the market more capital intense, not less. The bar has moved. So the thesis for today in one line is this. German venture capital is no longer in crisis, but it is still not built for the age of capital intense technology. That is the story I want to walk you through today. The specific German signal in the latest KfW and EY data, what it tells us about where German venture capital actually stands in 2026, and why the picture looks calm on the surface, but is anything but settled underneath. 2021 was the boom, not the benchmark. A short personal note, because context matters. Startup Radio did not discover the German venture capital cycle in hindsight. My co-host Chris and I were tracking the market in 2021 almost month by month. We were watching Celonis cross the unicorn threshold, then the decacorn threshold. We covered N26, Mambu, WeFox, the European unicorn trackers, the hotspot maps, then suddenly had German cities one of them. In 2021, Germany had its loudest startup year ever. 18.8 billion euros in venture capital, according to KfW. Almost 10 billion in the second half of that year alone, according to EY's data. I want to mention, this is not for nostalgia, but because that period now distorts the conversation. People who entered the German startup scene in 21 or 22 think 18 billion euros is the normal benchmark. It is not. That was a liquidity-driven acceleration on top of a zero interest rate, on top of an unusually abundant global capital, on top of a pandemic era digital tailwind. Chris and I were on the mic when that machine was running. That archive matters now because it lets us say with evidence rather than opinion, 2021 was an anomaly. The benchmark for German venture capital is not 18 billion. The benchmark is whatever the market can sustainably produce under more normal conditions. And the question is whether that sustainable level is enough for what Germany now needs to finance. 2022, when the vocabulary changed. By late 2022, the vocabulary in the German startup scene shifted. The conversation was no longer about unicorns and mega rounds. It was about funding crunches, dry powder, valuation resets, runway, discipline, and what people started calling the new VC cycle. The KfW data captures that correction with brutal clarity. 18.8 billion in 2021, 10.7 billion in 2022, almost halved. 7.1 billion in 2023, 7.5 billion in 2024, 7.2 billion in 2025. In other words, from the 2021 peak, the German venture capital market has dropped by more than 60% and then plateaued at a roughly that lower level for 3 years in a row. This was not a recession story. This was a separation story. The correction did not just shrink the market, it separated companies that depended on cheap capital from companies that could survive a more selective environment. Founders who had raised on the assumption that follow-on rounds would always be easy discovered that they would not. Investors who had pushed valuations up in 21 found that those same valuations were now a liability for the next round, not really an asset. By late 2022, even before the language stabilized, the structural question had already opened up. Once cheap capital is gone, what kind of venture capital market do you actually have? That's the question we're now finally in a position to answer with 3 full years of post-correction data. 2025 stabilization, but not victory. Here is what the post-correction market actually looks like. KfW reports the full year 2025 at 7.2 billion euros. The first quarter of 2026 came in at 1.7 billion, 6% above the same quarter last year, but 15% below the fourth quarter of 2025, sideways. KfW itself describes it as a Seitwärtsbewegung, meaning a sideways movement. EY telling a slightly different story. EY numbers for 2025 is almost 8.4 billion euros, a 19% increase versus 24, and the third highest figure on record. So on EY methodology, 25 looks like a recovery year. So why the gap? Because the two organizations count differently. KfW uses dealroom.co's database and captures a much broader range of rounds, over 1,400 deals in 25 alone. EY uses press releases and Crunchbase and captures the deals that get publicly announced, 716 rounds in 25. Different methodologies, different lenses, but both pointing the same direction. So whether you trust KfW or EY, the story is consistent. Germany did not collapse. Germany did not break out. Capital is available, but it is concentrating into fewer, larger, more selective rounds. EY counted 18 rounds above 100 million euros in 25, 6 more than the year before, and the total volume in that bracket rose by almost 1.5 billion euros to roughly 3.72 billion. That is the real shape of the German market right now, not a broad-based recovery, a concentration. The hidden story: fewer deals, larger rounds, fewer founders served. Let me put a sharper number on the concentration. EY reports that the total number of German financing rounds fell by 5% in 25 to 716 deals. That is the 4th consecutive yearly decline. It is the lowest deal count since 2019, and the second half of 25 alone counted only 318 deals, the weakest second half since 2018. At the same time, average deal size is up. KfW's data shows the median round volume rising again in its first quarter of 26. The number of large rounds above 100 million euros is up. The capital is not spreading, it's bundling. This matters for founders far more than the headline numbers. If you are a founder raising in Germany in 26, the market for you is not the same as the market for Helsing or Quantum Systems or Tubulis. It is a tighter, more discriminating market where investors expect stronger milestones, cleaner unit economics, and a clear path to the next round before they sign a term sheet at all. And here's the part nobody wants to say out loud. The structure of the German venture capital market is shifting away from breadth towards selectivity. That is great news if you are one of the few selected. This is bad news if you are one of the 700 or so companies that get into the top 18 rounds, because the market is no longer pretending that everyone gets a shot. Strategic sectors are now the center of gravity. This is where the data turns from predictive to strategic. EY's sector breakdown for 25 shows software and analytics at almost 2.7 billion euros, energy at 1.2 billion, health at 1.07 billion, climate tech, green tech, and clean tech combined at 514 million, hardware at 514 million, and newly broken out for the first time, defense tech at 449 million euros. Then inside software and analytics, here's the line that should change how we talk about German venture capital. Artificial intelligence received 1.708 billion euros across 70 rounds in 25. This is 64% of the entire software and analytics investment volume. KfW's first quarter 26 number is even more striking. German AI startups raised 967 million euros in 71 rounds in a single quarter. That is 58% of the entire German venture capital market volume in Q1 26. The 25 average was 43%. So AI is not just dominating in Germany, its share is rising fast. The other names that show up in EY's top 10 financings of 25 tell us what kind of country this market is now financing. Helsing, 600 million for defense AI. Green flexibility, 400 million for battery storage. Tubulis, 340 million for biotech. Black Forest Labs, 257 million for AI. Amboss, 240 million for medical knowledge. Quantum Systems, twice in 1 year for unnamed defense systems. Scalable for fintech. Nora Robotics for humanoid robotics. This is not the German startup scene of 2015 or 2018. This is not apps and consumer SaaS and direct-to-customer brands. This is strategic technology, defense, energy storage, biotech, AI, robotics, hardware, climate. The same sectors where government in Washington, Paris, London, Brussels, and Berlin are increasingly making policy decisions about national security and industrial sovereignty. And here's the structural problem. Companies in these sectors do not just need seed capital and smart angels. They need follow-on capital, procurement access, industrial partners, regulatory navigation, and patient scale-up financing across multiple rounds. They need the kind of long-duration capital that German venture capital market at its current size is not yet built to deliver. The capital intensity gap. This is the hardest single comparison in the data. KfW's benchmark table puts German venture capital investment at 0.16% of GDP. France is at 0.5. The European Union as a whole is at 0.17. The UK is at 0.6%. The United States is at 0.9% of GDP. Let that land. The UK invests almost 4 times as much in venture capital relative to the size of its economy as Germany does. The US invests almost 6 times as much. France out-invests Germany by more than 50% on this measure. Germany, of course, has the 3rd largest economy in the world. It has world-class universities, deep engineering talent, a strong industrial base. It has Helsing, biotech, Celonis, DeepL, Volocopter, and a growing defense and battery cluster around Munich and Aachen. And it invests less than 0.5% of its GDP into the technologies that will define the next 20 years of industrial competitiveness. In the United States, 4 AI companies, OpenAI, Anthropic, xAI, and Waymo, raised $188 billion combined in a single quarter. In the United Kingdom, Nscale, Wavy closed billion-dollar AI rounds. In France, Yann LeCun's new venture raised the largest seed round on record at $1 billion. In Germany, one confirmed mega deal above 100 million euros. One. Admittedly, there was a bigger deal, but it's not in the data yet, but we covered it in the news. The German problem in 2026 is no longer startup creation. The problem is capital intensity. The geography twist: Bavaria, Berlin, and the strategic clusters. The geography twist: Bavaria, Berlin, and the strategic clusters. And the geography is shifting too. For the second year in a row, Bavarian startups received more venture capital than Berlin startups. 3.3 billion euros into Bavaria in 25, according to EY. 2.68 billion into Berlin. 7 of the top 10 German financing rounds went to Bavarian companies, including Helsing, Green Flexibility, Tubulis, Ortivity, Quantum Systems, and Scalable Capital. Munich startups grew their venture capital intake by 38% year on year. This is not just an intercity rivalry. This is the German startup map becoming less about one startup capital and more about specialized technology regions. Munich for defense, AI, and quantum. Aachen for hardware, robotics, and second life battery infrastructure. Stuttgart and Karlsruhe for mobility and hardware. Hamburg for life sciences. Berlin for fintech, AI, software, and platforms. North Rhine-Westphalia rising steadily on hardware and energy. If you are an investor, this means the diligence map has changed. Berlin is no longer the default first stop. If you are a founder, it means location matters more than it did 5 years ago, because clusters now confer real economic advantages: procurement, partners, recruiting, and regulatory expertise. Closing the real test. So let me bring this back to the thesis. Germany has proven it can create serious startups. Germany has proven it can produce scientific, engineering, AI, defense, energy, biotech, and health companies that matter. The question is no longer whether Germany has substance. It does. The question is whether Germany can finance enough of these companies long enough, deep enough, and patiently enough to keep the upside, the ownership, and the strategic control of those companies in Europe. Because the alternative is not abstract. The alternative is that Europe becomes a place where category-defining companies are researched, funded, and early funded, and then somewhere between Series B and Series D, the cap table tilts. The lead investors come from the US. The next big round comes from US growth funds. The exit is an acquisition by a US strategic, and the upside, the data, the technology, and eventually the headquarters move with the capital. This is the strategic question Germany has to answer, not whether it can produce world-class startups. It already does. The question is whether the financing structure exists to let those companies become the next generation of European industrial leaders, with European ownership and European upside. Here's what I want listeners to do this week. Stop asking only how much VC was raised. Start asking better questions. How concentrated is the capital? Which sectors are absorbing it? Are scale-up rounds growing? Who owns the cap table? Is domestic capital present in the later rounds? Are German LPs writing the checks, or are they staying in private credit and public equities? And does the financing structure allow European companies to become global category leaders or merely promising investment targets? Germany has enough startup substance to matter. The open question is whether it has enough growth capital to control the upside. Stabilised, not strong. And the next phase of European competitiveness will not be won by markets that have merely stopped falling. It will be won by markets that have built a financing machine for the technologies that actually decide the next decade. That's the German venture capital signal in 2026. I'll be back next week. This is Jörn, Menninger for Startup Radio, Europe's voice on startups, venture capital, and innovation. Until then.
That's all, folks. Find more news, streams, events, and interviews at www.startuprad.io. Remember, sharing is caring.